Hashtag AI Tech News Intro. 5 stories breaking today. Groq lands a massive $650 million raise, Apple chips hit with an unpatchable flaw, Alibaba's AI video model climbs to number 2 globally, Meta's internal data exposed, and Anthropic's latest feud heats up. Stay tuned, this is huge, AI chipmaker Groq confirms $650 million raise, restaffs after Nvidia's $20 billion not-acqui hire deal. Groq just pulled off a $650 million funding round, and the timing tells you everything about what's really happening in the AI chip wars right now. This isn't just another venture capital win, it's a direct response to Nvidia's aggressive talent acquisition strategy, which just vacuumed up a massive chunk of the AI engineering talent pool. When Nvidia closes a $20 billion deal to essentially absorb a company's best people, competitors have to act fast or get left behind. Groq's move shows they're not backing down, they're doubling down on their own vision for AI infrastructure. Here's what makes this interesting from a technical standpoint. Groq has been building something genuinely different. Their NeoCloud platform is designed to handle AI inference at speeds that challenge Nvidia's dominance in that space. While everyone obsesses over training massive models, inference is where the real money lies. It's the part that actually runs the AI in production, serving millions of users. Groq's architecture is optimized for this, and they're betting that enterprises are hungry for alternatives to Nvidia's ecosystem. The new funding gives them the runway to prove it works at scale. The broader story here is about ecosystem fragmentation in AI. For years, Nvidia had an almost monopolistic grip on AI compute, but that's starting to crack. Groq, along with companies building custom silicon and alternative platforms, are finally getting serious investor backing. This $650 million raise signals that venture capitalists believe there's real market demand for non-Nvidia solutions. Whether Groq can actually execute on that promise is the question that matters, but one thing's clear, the AI infrastructure market is becoming genuinely competitive for the first time. A new unpatchable flaw in Apple chips opens the door to an iPhone jailbreak. Apple's security fortress just got a massive crack, and it's one that can't be patched. A European cybersecurity firm has publicly disclosed a fundamental flaw in Apple's chip architecture that gives hackers a direct pathway into older iPhones, completely bypassing the company's legendary security defenses. This isn't some theoretical vulnerability that exists only in labs, it's a real, exploitable technique that's now in the wild, and it fundamentally changes how we should think about device security. Here's why this matters so much. Apple has built its entire brand reputation on the idea that iPhones are impenetrable fortresses. That narrative has been central to their marketing, their privacy promises, and their premium pricing strategy. But this flaw exposes something uncomfortable. Some security vulnerabilities exist at the hardware level, baked into the actual silicon itself. You can't patch silicon. You can't push an update to fix it. The only solution is to physically replace the chip, which means millions of older iPhones are now permanently vulnerable. This is a humbling reminder that no company, no matter how sophisticated, can guarantee absolute security. The broader implications here are significant for the entire tech industry. As our devices become more AI integrated and handle increasingly sensitive data, we're discovering that the race to build faster, more powerful chips sometimes comes at the cost of security considerations. This incident will likely trigger a massive reckoning across the industry about how hardware vulnerabilities are disclosed, how companies design for security from the ground up, and whether the current patch-based security model is even viable anymore. For consumers, it's a wake-up call. The device in your pocket might have vulnerabilities you'll never be able to fix. Alibaba's AI video model rises to number 2 in global rankings, as OpenAI's Sora and ByteDance fall away. The AI video generation race just got a massive shakeup, and it's not who you'd expect winning. Alibaba's Happy Horse just jumped to number 2 globally, and it's doing it while OpenAI's Sora and ByteDance competing models are essentially disappearing from the market. This isn't just another product update, it's a signal that the entire landscape of generative AI is shifting in unexpected ways. Here's what's happening. Alibaba Cloud just released Happy Horse 1.1, and they're positioning it as genuinely production-ready for real businesses. They're offering full API access to enterprises and developers, plus a 40% discount for the first 2 weeks. Meanwhile, OpenAI quietly discontinued Sora because it couldn't make the economics work. That's huge. Sora was supposed to be the gold standard, the thing that would define AI video generation for years. But it turns out building a world-class AI video model and actually making money from it are two completely different problems. What this reveals is something crucial about the current AI boom: technical capability and commercial viability are diverging. You can build something incredible in a lab, but if you can't figure out how to monetize it at scale, it dies. Alibaba's advantage here is that they have massive cloud infrastructure, enterprise relationships, and they're willing to play the long game with pricing. They're not trying to be the premium consumer product, they're going after the entire business ecosystem. That's a smarter play right now than chasing viral moments or consumer adoption. The broader implication is that we're entering a phase where the winners in AI won't necessarily be the companies with the flashiest demos. They'll be the ones who can actually integrate these tools into existing business workflows and make them economically sustainable. Alibaba getting to number 2 isn't about having the best technology, it's about having the right business model at the right moment. Meta exposed data internally from its controversial employee tracking program. Meta just got caught red-handed exposing sensitive employee data from one of the most invasive workplace monitoring programs in tech history. We're talking about keystroke tracking, the kind of surveillance that sounds like science fiction but is very much real, and the company accidentally leaked internal information about it. This is the kind of story that reveals exactly how far some of the world's biggest tech companies are willing to push the boundaries of worker privacy in the name of AI development. Here's what's happening behind the scenes. Meta has been collecting keystroke data from employees to train artificial intelligence models, which means they're literally recording what workers type throughout their day. Employees flagged this as deeply problematic months ago, raising legitimate concerns about privacy and consent. But instead of listening, Meta apparently kept the program running and then exposed data from it internally. It's a stunning failure of both ethics and basic operational security that shows how little regard some companies have for worker autonomy. The bigger picture here is that this represents a dangerous trend in how tech companies approach AI development. They're treating employees as data sources rather than people deserving of privacy and dignity. When you're training AI systems on keystroke patterns, you're capturing everything: passwords, personal messages, confidential work, medical information, you name it. This sets a precedent that's genuinely alarming. If Meta gets away with this, other companies will follow, and we'll end up in a world where workplace surveillance becomes the default rather than the exception. What makes this moment crucial is that employees are finally pushing back publicly. This data exposure might actually be the wake-up call the industry needs to reckon with how it's treating workers in the AI era. The question now is whether regulators will actually step in or if tech companies will continue operating in this gray zone where profit margins matter more than people's fundamental right to privacy. 3 things to watch amid Anthropic's latest feud with the government. Anthropic just picked a fight with the US government, and this isn't some minor regulatory squabble, it's a showdown that could reshape how AI companies operate in America. Back in April, the company announced Mythos, an AI model that apparently crossed some line the government wasn't comfortable with. Now we're in June watching this feud escalate, and the stakes are way higher than most people realize. Here's what makes this significant: Anthropic has built its entire reputation on being the responsible AI company, the one that plays by the rules and prioritizes safety. So when they're openly clashing with federal authorities over Mythos, it signals that even the most cautious players in this space are hitting friction points with government oversight. The technical details matter here too. Whatever capabilities Mythos has apparently triggered national security concerns, which tells us the government is actively monitoring AI development and willing to push back when they think a line's been crossed. But the real story is what this means for the entire industry. If the government can pressure or restrict Anthropic, they can do it to anyone. This creates a chilling effect where companies might self-censor their research, slow down innovation, or relocate operations overseas to avoid scrutiny. We're watching the beginning of an arms race between Silicon Valley's move-fast mentality and Washington's desire to maintain control over transformative technology. The outcome of Anthropic's feud will essentially write the rulebook for how AI development happens in this country for the next decade. Thanks for staying updated with Neural Brief. Subscribe and hit the notification bell so you never miss tomorrow's biggest AI breakthroughs. See you next time.